All right, we're moving right along. We are on Learning Objective 3-3. We finished up 1 and 2 in the previous video, and now we're moving on to liabilities. Liabilities represent obligations to other entities. Okay, so what are current liabilities? Current liabilities are those things we're going to have to pay within the coming year. Okay, I wrote that accounting equation out for you. We have our current assets, current liabilities, long-term assets, and long-term liabilities. We want to know, do we have enough current assets to pay our current liabilities? If this is not a one-to-one ratio, if it's any less than one-to-one, we would start worrying about the ability for this company to pay its short-term liabilities as they come due. Okay. Examples are accounts payable, notes payable, or short-term borrowing has to be 1 year or less. Any deferred revenues, we had a customer pay us cash in advance of the service being provided. That is a liability, not a revenue. A lot of students miss that at least once. Okay. Any accrued liabilities, this would be if you had interest expense that you had accrued. The expense happened, you just haven't paid for it yet. Okay. And then current maturities of long-term debt. So we may have long-term debt. We may have long-term debt of 30 years on our long-term liabilities, but what we have to pay within the coming year has to be reclassified into current liabilities. Okay. So accounts payable. Sometimes they'll call this trades payable, kind of like trades receivable. But these are obligations to suppliers of merchandise or services purchased on account, sorry. Payments usually between 30 to 60 days. There is no interest on an accounts payable or accounts receivable. Notes payable is going to be a written promise. It will have an explicit interest added to it. Okay. Then we have those deferred revenues. We're going to earn the revenue later in the future, but we got the cash right now. Really good example. Sale of gift cards. Um, Used to people would subscribe to magazines. I don't know if anybody even does that anymore. I still have a lifetime supply of Southern Living from my mom, and she's been gone for quite some time now. I don't think I'll ever stop getting Southern Living magazine, but that's how the magazine subscriptions worked. You sent your money in, you paid for a 1 year subscription, and then that company, as they publish that magazine every single month, they're earning a little bit of that revenue. Okay. They can't earn it right when they get the cash because remember, we're not on cash basis accounting, we're on accrual based accounting. Okay. Then we have accrued liabilities, kind of talked about interest payable, salaries payable, all of those things that we have gotten an expense on them already. An expense has incurred, but we just haven't paid for it yet. We'll pay for it in the next period. Okay. I've already mentioned current maturities of long-term debt and some long-term debt examples, long-term notes, bonds, pension obligations, and lease obligations. Okay, we have a whole chapter on pensions to come. All right. I'm kind of skipping over some of those little questions. Y'all are free to go back and look at those on the PowerPoint or pause the video and look at it. All right. So now we have the shareholders' equity. We have all of these different things, and we've kind of talked about them some. We have our paid in capital. That is our common stock and paid in capital in excess of par. We have that accumulated other comprehensive income. They didn't put it on here, but I'm going to add it again. Don't forget treasury stock because treasury stock is going to be completely different and it will have its own line in the shareholders equity section. Okay, here's Nike's. We can see where all the money is coming from. So we have I'm guessing that's 3 million and in just common stock. Remember this additional paid in capital, that's everything over par value. Retained earnings is all of your net income, net losses, and dividends that have been paid out over the life of the business. Okay. I like to draw that T account out for retained earnings so that you know what's going in and out of retained earnings. We hope that it starts with a credit beginning balance. We would add net income on the credit side if we have net income. If we don't have net income, we would have net loss. Net loss would be on the debit side of retained earnings, and dividends would be coming out of retained earnings. And we hope that we have an ending balance on the credit side. But remember, this is one that could trick you. It actually could flip over to a debit balance because you may have a lot of net losses and you may have paid too many dividends. Okay, that's not good. This number would be put into those financial statements with brackets around it because there would be a deficit and it would be bringing shareholders' equity down. Okay, I'm going to kind of skip over some of the international financial reporting standards. We got a lot of stuff to cover here. All right, let's talk about the annual report. I'm going to try to remember to bring some. I'm actually in my office right now and I have a stack of financial reports over here from various years, and it's got all of the disclosures. So, like, there are at least 100 pages in each one, but financial statements are probably going to take up maybe only 4 or 5, maybe 6 pages of that. The rest of it is notes to those financial statements. Okay. And lots of different things in there. There's management's letters, just lots and lots of information. There's more stuff in there than there is numbers. Okay. All of these disclosures are going to explain what's in those handful of financial statements. Okay. Like you got inventory. What kind of inventory system are you using? Are you doing LIFO, FIFO, weighted average, specific identification? That's disclosed in the notes because that's going to help us make decision on what those financial statements say. Okay. All right. We would have a summary of significant accounting policies that just conveys valuable information about the company's choices from various alternative accounting methods. It could be subsequent events. Subsequent events happen after the year-end date, okay? But there could be a major event that happens right after that, okay? So, say our financial statements are dated December 31st, but on the 30th of January, we had a warehouse and with inventory burned to the ground that was worth $500 million. It's not something that affects this year in, but it is a subsequent event that we need to know about because it will affect the future. Okay. So that's something like that. Issuance of debt or equity securities, any business combination or sale of business, if there's a big merger that happened from the balance sheet date until the annual report date, that needs to be put in there. Any sale of assets. Okay. Noteworthy events and transactions. Related party transactions are huge. We talk about these a lot in an audit because related parties are, co-owners. They're your families of those key employees, because any kind of transaction there, we're kind of going to look at and we're going to say, there could be some fraud in that. Was it an arm's length transaction? So if you had that same transaction would have happened with anybody else, then it's a good transaction, okay? It's an arm's length transaction. That's the verbiage that they use for that, okay? There can be errors and frauds, okay? There can be lots of errors in the financial statements. Major material ones do need to be disclosed. Usually, small errors that are in the financial statements, most of the time, the company's going to fix those before they actually issue these financial statements. So there's not going to be an error in that. Okay. And you got to remember, most businesses want a good, clean opinion from their auditor. So it doesn't really matter. They're going to do whatever they can. They're going to jump through a lot of hoops to get that clean opinion that doesn't raise any red flags or anything like that. Okay. Fraud, on the other hand, is intentional. Any fraud that is found needs to be disclosed. Okay. Illegal acts, bribes, kickbacks, illegal contributions to political candidates, and other violations of law. So the most frequent of these is the related party transactions. Okay. Then we have the management discussion and analysis. Okay. This is going to tell us, I always say it's kind of, if it was a bad year, they're going to tell you why it was a bad year and then proceed to tell you what they're going to do to have a good year next year. Okay. Because that is them trying to convince you to keep your money invested in them. Okay. Um, It's going to have results of operations, liquidity, capital resources, off the balance sheet arrangements, any off the balance sheet debt they have. Okay. Critical accounting estimates. There's a lot of estimates that go into the financial statements. Depreciation, bad debt expense. Those are just estimates. We don't know those to be absolutely 100% for sure. Okay. Management responsibility is to prepare the financial statements and other information in the annual report. You probably were thinking that was the auditor's job. It's actually not. The auditor's only job is to provide an opinion on that report. Okay. Management is responsible for those financial statements. Okay. Auditors do a really good job of disclaiming their way out of a lot. Okay. Because they don't want to be the fall guy for something that a company did illegally. Okay. It asserts the responsibilities of management for the information contained in the annual report, as well as the assessment of the company's internal control procedures. So now, since Sarbanes-Oxley came about in 2002, we have basically a dual audit going on now. We have an audit of the financial statements and we have an internal control audit. Prior to this, all we did was if internal control was working really good, we may rely on those controls a little bit more, but now internal control has to be evaluated. So there's an opinion on the financial statements and an opinion on the internal control. Okay. Any compensation of directors and top executives. Okay, a proxy statement. This needs to be provided each year to all shareholders, usually along with the annual report. Okay, this invites the shareholders to annual meetings to elect the board members, vote on issues, or to vote by proxy. Okay, includes compensation, stock option information for directors and top executives. Okay. There can be environmental, social, and governance disclosures because if you're dumping toxic waste into the river, it does affect the financial statements because that company is going to get fined. Okay. They're going to get fined and that will affect the financial statements. Okay. Social disclosures, they are going to include issues of interest to broader stakeholders and society at large, CEO payout, gender pay ratio, gender diversity ratio, because we don't want corporations just to make us money anymore. We want corporations to be good corporate citizens. Okay. So, so that's what is demanded of them these days, even though that's not what they were started for. Corporations were started just to keep some liability down, and it was to make money. Okay. But we don't like that these days. People want to see corporations doing things. We are here in Conway where Tacos for Life started. It makes us feel good to go buy that really expensive taco and they feed a child a meal. Okay, not a taco from Tacos for Life, but it provides a meal to a child somewhere that does not have it. Okay, all right, that is all for this video, and I will see you in the next one.